Good morning, everybody. Welcome back to the Opportunistic Trader. It's 10 a.m. on Wednesday, October 3rd, which means Wednesday is DOE Day. We're joined by Phil Flynn of the Price Group and Fox Business Contributor. How's it going, Phil?
I'm doing good today. We're very excited about all the news coming out. The ADP job report rocking and rolling. U.S. non-manufacturing just flew away expectations. It's a good day. The economy's doing good. I'm thrilled.
Well, let's start there. We'll get to the energy in a little bit. We have DOE coming up in about 30 minutes, but let's start with that. Actually, it was a very, very solid ADP report, but there was very little reaction. Bonds, the 10-year, moved down about a tick. Dollar yen moved up a few ticks, but very, very small reaction. What are your thoughts there?
I think that they're waiting for the granddaddy of them all. I think they're waiting for the big report. I think there's a lot of expectations built into what we've been seeing by other economic data that's going to be a very, very strong support report. And I think that now you're getting into a situation where a strong report could raise fears that the Fed's going to be more aggressive. And that's kind of where we're at right now, because we're in this rising rate environment, and we're getting to the point where good news isn't necessarily
And also,
good
let me just
news.
break in with this. Right at 10 o'clock, right when you came on, SEP ISM non-manufacturing was very strong at 61.6. They were expecting 58. So this is the highest reading since 1997. So that's another very strong figure. And, I was wondering, I took a look, dollar yen moved about 10 pips on that. And the 10-year is now on the low of the day at 118.19. So that's down 6.5. So, very strong data today.
It is, and I think you're seeing the yields start to reflect the fact that the Fed's going to continue to raise those interest rates when you get strong data like this. And then not, everybody was saying that manufacturing in the U.S. was given up for dead. Those numbers were spectacular. But here, nobody can complain about the service side of the economy, right? Because this is supposedly the biggest part of our economy. And to say that that number is the strongest since 1997 is absolutely incredible. So it really does show you that the economy is doing great. The only negative part about that is, of course, that the Fed may choose to be a bit more aggressive at some point, and concerns by the Fed that maybe some of this is too good to be true. The news is just too good, and so the Fed is definitely going to be on guard. And I think that's why we're not seeing a euphoric reaction to the numbers, but definitely a solid reaction to the numbers. I mean, we're not breaking, the stocks, and the path of least resistance in the stock market is still to the upside.
Yeah, look, I mean, you've been coming on multiple times a week for a few months now, and you've been bullish oil, bullish the economy,
Mm-hmm.
and supportive of equities, and that's really been the theme. Look, we've had a lot of solid data, but even with it, it's still, yesterday we had, so last week we had the FOMC decision. Yesterday we had Fed Chairman Powell on, and he didn't really say anything new. Today we have about five speakers, I think 4 or 5 Fed speakers. So, the economy's strong, so it's, but it's interesting though, the lack of reaction, like euro here down 15 pips. Pound's actually higher on the day, so that's kind of the head scratcher. Gold actually did just drop; it was up a few dollars, and it's kind of
Mm-hmm.
moved down. I think that's what dollar yen.
Yeah, I think gold, though, from a technical viewpoint, looks like it may have turned the corner a little bit. Picking a bottom on gold, of course, is about as reliable these days. It's picking the Cubs to win the World Series this year. But it does look like that we closed above some major resistance on gold yesterday. And one of the telling things that I saw is that when gold was breaking down last week, silver was holding in there pretty good. So the gold might go up a little bit. We did hear from Jerome Powell on the inflation front, said, hey, he's ready. Inflation, I'm watching for you. You're out there. If I see you, we're going to react. So that's something to keep in the back of our mind as well, to look at the inflation part of the data. So far, that's been pretty muted. But yeah, I think that if you look at the market right now, there's an old saying in the business: buy them when they're leaping, sell them when they're creeping. So I think it's actually a good thing that we're not having huge reactions to the positive data. I'd rather have a creep than leap. Because when you start leaping, that's when you have your best chance for a big correction.
It's pretty interesting also. S&P following this strong ISM number. S&P is at the high of the day here, up 13, and dollar's actually stronger as well. Yields higher. So we're also not at the point right now where the market is fearful of where yields are. At least that's what we're being told in the short term here, because yields are pretty much on the high of the move here. The 10-year, not exactly on the high of the move, the 10-year, but the 10-year as we speak is 309. I think we got up to 311, but still, we broke through that 3% level in the 10-year and have not really gotten back below it.
Yeah, it's amazing that we live in an environment, where we're afraid of a 3% yield. Seriously, I mean, if you're a student of history, 3% is still historically low, um, and so I agree. The market shouldn't be afraid of these rising yields at this point. Um, in fact, one would argue that going through years of quantitative easing, extraordinary stimulus, that a 3% yield is still relatively cheap. And very stimulative where we're at. So I don't think 3% yield is going to rattle the stock market. I don't think Fed increasing interest rate at a moderate pace is going to derail the stock market. So I think as I was talking to one client today, made a very good point. He goes, everybody wants to hate this market. Everybody wants to pick a top, and when you get everybody wanting to pick a top, sometimes the top never comes because you keep selling into it, have to buy it back, keep selling it into it, and you can't have to buy it back. You know, maybe we're going to have to see the actual, bullish momentum and the doomsayers, turning more positive before we'll actually get a correction.
Yeah, but the one remarkable thing, and I actually just posted it in the chat. The 1-year Treasury yield in 2009 was 37 basis points. Then in 2011, it went down to 12 basis points and basically hovered there for years and years to 2015. We're now up to 261.
Mm-hmm.
You can get yield for short term actual return. We're not talking 2 basis points or a tenth of a percent. We're talking a few percent. So that's something that I think some equity players will start to take a look at some point.
Well, yeah, I mean, but look at the return you're getting on stocks right now. So there has to be a little bit of fear in the marketplace or incentive to move that money back into bonds.
Sure.
And because fixed income has been such a terrible investment, and has really underperformed the stock market consistently for many years, I think there's going to have to be some type of a fear factor that really gets into the marketplace to get that money to move. Um,
A big fear that everybody has is the fear of missing out.
that's true.
The fear
That's
of
true.
missing out, like you just said.
Right.
Hey, I'm
Yeah.
I'm happy in my bonds for a year, getting 2%. But hey, my neighbor's getting 12% in equities.
Absolutely, and that's probably going to continue to be the case for some time. And you look at the VIX index; it's bouncing around a little bit. We're not seeing that fear in the marketplace. We're and the other thing that I would say is that as strong as the stock market is, it's not euphoric. Everybody that's looking for like a stock market crash, generally every crash I remember, the 87 crash, the crashes in the 90, usually was based on the point where the bullish enthusiasm was so strong that the Dow was going up, incredible percentage points almost every day. And as strong as this market is, the increases have been, relatively not wildly crazy, but very strong. So I think if you look at the big picture, I think the market has some room to run.
Yeah. So let's take a look at today's energy report. Once again, you've been kind of on the bullish side of crude for many dollars now, and here we are hovering at $75 as we speak. The high overnight was 75.57. We got off to a great start to Q4 with a very big move in crude and most energy markets on Monday. What are you thinking here? What are we looking at for DOE?
For a shorter term target right here, $75 was one of our shorter term targets. So I wouldn't be surprised to see us consolidate in this area for a couple of weeks. We are in the heart of the refinery maintenance season. And usually demand goes down a little bit. So I guess if you're a trader, you got to love this. I would say right now, if oil breaks a couple of bucks, screaming buying opportunity. But maybe if we rally $2, at least for a short-term viewpoint, it might be a sell. So I think we're going to be a little bit range bound here, maybe for the entire month of October. But as we get closer to the Iranian sanctions, you got to be prepared for an upside move. And we would expect, a $10 to $15 rally to cap out the year from current levels. So really, you have to be careful that you don't want to be too weighted on the short side, because once this thing breaks out, it's probably going to run. What we saw in the inventory report last night seems to suggest that even though the U.S. refining industry is going deep into maintenance, the build and crude supply isn't nearly what you would expect it to be. And if the API is right, U.S. crude supplies built less than 1 million barrels at a time where we are expected to see a huge drop in refinery runs. That should raise some concerns about the supply situation as we get closer to the Iranian sanctions. Now, part of the reason why we're probably not seeing the supplies build is because Europe is short of supply. And we have this huge spread between the Brent and the WTI. That's going to open the export window, get a lot of oil going overseas. So the exports are probably really strong. But then you break down into the actual product declines, which were larger than expected on both gasoline and distillate. I believe there was a 1.197 million drop in distillate supplies, almost a 1.7 million barrel drop in gasoline supplies last night. So what that tells me is that the demand for the products is above par for this time of year. Now, maybe on the gasoline, it's because summer hasn't ended. Really, I mean, we have beautiful weather in most parts of the country right now, so that's probably encouraging a little bit more demand. The other thing on the demand side is that the economy is doing great. I mean, we're talking about the numbers. The best economy that we've had since 1997. People are making the most money they have in years, usually bodes well for gasoline demand. But we are seeing a buildup at the pump. A lot of states right now are now above $3 a gallon. We're starting the month of October with the highest gasoline prices that we've seen probably in a decade. So you do have to worry at some point if we get a price spike. Is that going to slow down demand? And to be honest with you, based on the charts right now, and based on the potential impact on the price of crude and what it can do to gasoline prices, we could see a 20-cent rally in gasoline prices. We could get a national average above $3 a gallon before the end of the year. And we kind of know psychologically that's kind of a turnoff for a lot of drivers at that point. But up until now, we're not really seeing that much demand resistance to higher prices. There are some reports that are saying, yeah, we're driving less miles. Yeah, we're down a little bit, but it isn't significant enough of a drop from record highs that's going to cool down these prices at the pump.
Yeah, so it'll be interesting to watch price action, I guess, because also, if this were some sort of bearish number, it's interesting to see, what sort of support comes in. We've been in such a bullish mood. I know that CTA's trend followers are heavily long energy at this point, both Brent and WTI, which also brings me to the next point of that spread, the old Brent WTI spread. We're just under $10. It looks like we're at about $9.70. Any information or thoughts on that spread?
I think that it has a chance to come in after the sanctions go into place, because what we're seeing right now is some of the countries that usually send oil to the U.S. are now foregoing to that, sending it to Asia because of that spread. So that's going to be the play until the sanctions get in place. Generally, it's going to be a buy the rumor, sell the fact type of thing. I think the spread's going to continue to stay strong, but once the sanctions go into place, the U.S. then, of course, is going to have to attract more barrels. So the WTI is going to have to start catching up to the Brent. So we would expect, thus far it's been the Brent pretty much dragging the WTI higher. as the focus of the sanctions start to really dig in, the U.S. will be dragged higher, and that spread should come in.
Yeah, it's a lot of people talking about it, especially in the energy market. So a lot of people paying attention to that. Keep a close eye on that. So here we are. Crude is at 74.94. We got about 15 minutes till the data.
And the back end of the curve is another thing you want to keep an eye on the WTI. I mean, look at some of your out months, December 2020, December 2021.
Where is DC20 right now? I don't have it in front of me.
Let me get a quote for you real quick because I just had it up here. And it's come up a couple of dollars in the last couple of days. It seems to be gaining on the front end of the curve pretty solidly. And let me wrong here. Bear with me 1 second here. And we're I'm faster on this one. I don't have a thing in my ear, which is funny. Okay, there we go. There we go. There we go. Right now on the December 20 crude, we're trading at $67.34. So if you consider that spread with the front end of the curve, you've got you did have an over a $10 spread differential on those. One would expect that we're in a new era of higher prices, that we should gain on the front end of the curve over the next few months and get this market back up to the 70s. So and over the next 2 years, maybe a $20 rally. So from a long-term viewpoint, we think that this market's fundamentally underpriced. Now, we could get a pullback. I mean, you've got to be careful, but I think you're going to see the back end of the curve really start to gain on the front end of the curve over the coming months. Now, it's a little difficult to spread because you can get these squeeze play situations over the next couple of months. So I wouldn't necessarily go short the front and long the back. I would just prefer to maybe have some long exposure across the curve. Don't do everything in the front end of the curve necessarily, maybe pick it up in the back end.
Interesting. Yeah, well, that's a pretty good spread over there. I know it's about a year and a half out, but still, actually, I guess 2 years. Not a year and a half. All right. Well, Phil Flynn from the Price Group, Fox Business Contributor, thank you very much for joining us, giving us some great information. We'll all eagerly watch in about 12 minutes DOE figures, what's actually released, but I think more important will be actually the price action after, being that we're in such a bull trend here, to see how we react to the data. So we'll keep an eye on that. We'll keep you updated.
Thank you.
All right. Thanks, Phil.
Thanks.